If you're an AQA A-Level Business student looking for a video to revise all of Unit 1 What is Business, well, this video is for you because we're going to go through everything that you need to know for your exams, including how do we measure profit. We'll also take a look at typical objectives that a business may set. We'll then look at the difference between limited and unlimited liability, which will lead nicely into the different forms of business, including sole traders, private and public limited companies, along with the advantages and disadvantages of each. And then finally, we'll wrap up the session looking at the external environment and how different factors could influence a business's cost and demand. Let's get into it. The first topic that we'll look at in this revision video is how do we measure profit. Now, when calculating profit, there's two important elements, revenue and our costs. And let's break these down. Starting off with revenue. Now, essentially, revenue is the money that a business will make from selling their products or services to customers. And the way we calculate this is where we take our selling price times by the number of units sold. So, for example, I sell a water bottle for £10 each and I sell 10 units. 10 times 10 would give me a revenue of £100. Now, of course, it would be great if we just had to look at our revenue, but there are also costs that a business will need to factor in. And the first type of cost that we'll look at will be our fixed costs. Now, students typically get this wrong. They just say fixed costs are costs that do not change. But it's do not change in relation to what? So the correct way of defining what fixed costs are is that they are expenses that do not vary with the level of production. Now, for example, if we looked at renting out a warehouse for £10,000 a month, now, if you think about it, doesn't matter if I produce 1 unit, 10 units, 1,000 units, or 1,000,000 units within that warehouse, my rent, my fixed cost would still be 10 grand a month. And fixed costs will change over time. It's just within the short term, they stay the same. And some examples that we have of our fixed costs, we've got rent, salaries, permanent staff wages, insurance, and also our loan repayments. But of course, we also have our variable costs. So if fixed costs do not vary with the level of production, your variable cost will vary with the level of production. So the more that you produce, the higher your variable cost be. And the less that you produce, the lower your variable cost would be. And the way we calculate our total variable cost is that we take the variable cost per unit and multiply this by the total units of output. So as you can see, the more we produce, the higher our variable cost is going to be. And some examples will be our raw materials. So of course, the more products that we build, the more raw materials that we use. The packaging, the direct labour wages, and of course, if we do any delivery expenses. Now, a real simple calculation is to figure out, well, what is our total costs? Well, we've only been through 2 examples, and if we want to find the total, we just add them together. So our formula for total cost will be your fixed costs plus your total variable costs. And now we've got all the components to calculate profit. Now, the way we calculate profit is that we take our total revenue minus our total costs. Now, when this value is a positive, we are making a profit. But when this value is a negative, we are making a loss. The next topic that we're going to take a look at in this revision video will be about the different objectives that a business may set. Now, there's a few different ones that we need to look into. First of all, will be around profit objectives. Now, we've just looked at the formula for profit. This is equal to your total revenue minus your total costs. Now, the reason why a business would want to have objectives about increasing their profit, well, first of all, it's a great indicator for financial health of the company. Because over the long term, a company's success will depend on the amount of profit they make. It can also be used for reinvesting back into the business, which is a great source of internal finance. And finally as well, when a business makes profit, this belongs to the shareholders and they can pay themselves either through dividends or through capital gains, so their share price increases. Now, how does a business go about increasing profit? Well, using the formula, we can either increase revenue or decrease costs. And if we can, try and do both at the very same time. It's important to note that a business shouldn't just focus on profit objectives because they could be making their profit in unethical ways. And I think it's going to be important to have profit objectives mixed with ethical objectives. Another important objective to have for a business will be around their growth. So in terms of how a business would measure their growth, it could be increasing in brand awareness so more people know about them. It could also be around increasing the level of sales and profit. And finally, it could also be about increasing their market share. Now, what we mean by market share is that out of the total market sales, how much has my business contributed to it? Imagine the total market sales is represented as a big cake. What we're figuring out is how big is my slice. And a great model that you'll learn in year 13 about how a business can grow is Ansos's matrix. And there's 4 strategies. market penetration, product development, market development, and diversification. Now we'll take a look at this and a lot more in Unit 8. And another key objective that a business may set may be around their survival. You might be asking, well, that's a bit of a weird objective just to survive as a business. Not until you hear this. A study was done and they actually identified that 70% of businesses fail after 5 years. So actually being in 30% can actually be quite successful. Just surviving as a business can be deemed as a success. Now the reason why businesses fail, they make a product or service that no one wants, but typically it's because they run out of cash. So in order for a business to survive effectively, they need to manage their cash flow. More on that in just a moment. They will also want to build a strong customer base, so having products and services that satisfy customer needs and are loyal to us so they keep buying from us over and again. And of course, we need to make sure we're adapting to change. So if we see any advancements in technology, we don't want to fight against the tide, we want to swim with it. And finally as well, it would be implementing strategic planning. Now, what we mean by that term strategic is that we're looking at the decision making of the business over the long term. And something that I've actually just mentioned, but can also be a key objective for a business, is to have a healthy cash flow. Now, all cash flow is the movement of money coming in and out of the business. Now, if the business doesn't have a healthy cash flow, then they're not able to pay their expenses. And if they don't pay their expenses, they could be fined and eventually end up going bankrupt. So your cash flow is essential for the success and survival of the business. The way we calculate our net cash flow, and across Unit 5, we'll go into this in a lot more detail. All we do is we take the cash inflows and minus the cash outflows. So quite simply, you want more money coming in than going out. And cash flow is going to be important for all businesses, not just your startup, also your large multinational companies. Now, in terms of how we write our objectives, typically we follow the SMART process: specific, measurable, achievable, relevant, and time-bound. So for example, we could be around increasing monthly cash inflows by 10% within the next 6 months by improving credit control. And then when we look at credit control, it's just the credit offering that you either give to your customers so they can buy a product today but not pay until 3 months' time, or the credit period that you have for your suppliers. You can receive your supplies today, but not need to pay until 3 months' time. And finally, the business may decide to also set social and ethical objectives. Now, what we mean by ethics, essentially, it's just doing the right thing. It's acting in a moral way, which is going above and beyond what is legally required of you. So here are some examples on the screen. So first of all, we could look at supporting community development. So potentially investing into the local community, sponsoring different events. It could also be around following sustainable practices, or it could be looking at ethically sourcing raw materials, so obtaining materials and products in a manner that is respectful of human rights and the environment, and this is often done through fair trade agreements. We could also look at communicating openly and truthfully with all of our different stakeholders about our business practices, policies and performance. Once again, this could just help build trust and credibility. And finally, promoting more fair labour practices. So ensuring equal opportunities for all employees and treating them without discrimination. Now, in Unit 7, we go into this in a lot more detail about how a business can be ethical and follow CSR practices. The next topic in this revision video that we're going to take a look into will be our mission and objectives. Now, we've just identified some key examples of business objectives, and these are the short-term goals that they want to achieve. But what are mission? What are our corporate objectives? Well, we've got this pyramid here which shows the relationship with our mission, corporate aims, corporate objectives, and functional objectives. Now, first of all, with our mission, you typically find a mission statement is a brief qualitative statement that summarizes the purpose and core values of a business. Essentially, the mission statement explains why the business exists, and this is a lot more strategic, but sometimes less specific. Then we have our corporate or business aims, and these are more the long-term goals that a company wants to achieve. And these will actually provide guidance for setting objectives. So, for example, it could be around to become the leading provider of electric vehicles in the global market. So this will then start to help us set our corporate objectives. And your corporate objectives, these are now more specific and measurable goals set by a business to guide its operations and strategic direction. So this could be around how we look at increasing market share. And then finally, we could look at our functional objectives, which are more specific goals for those business functions and departments. Now, when we look at our business functions, think of finance, HR, marketing, and operations. The next topic that we'll take a look at in this revision video will be the difference between limited and unlimited liability. And this is a very important concept, especially when we look at the different business forms. Now, what actually is unlimited liability? Now, essentially, unlimited liability is when the business owner and the business is treated as the same legal entity. So what that actually means is that if my business that I'm operating goes into bankruptcy, maybe having a debt of over £100,000 that it can't pay, well, if the business and myself are the same legal entity, well, it's not just the business that is in debt for £100,000. It's also myself that is in debt for £100,000. So what that means now is that I'm personally responsible for all those business debts. So my personal assets are at risk. Because what they could do is they could look at everything that I personally own, such as my house, my car, and they could seize those assets up to worth £100,000 to pay off any of that debt. Now, unlimited liability is present in our unincorporated business forms. They will be your sole traders and your partnerships, but we just need to know about sole traders for AQA. So, what is limited liability? Well, this is pretty much the opposite, because before with unlimited liability, we're treating myself and the business as the same legal entity. But with limited liability, we are now treating the business owners and the business as two separate legal entities. So if this business here goes into debt that they can't pay, well, I'm legally protected because I'm a separate legal entity to the business itself. So what limited liability means is that the business owners are only responsible for the money that they've invested into the business. So as they are that separate legal entity, my personal assets now are protected. And limited liability is present in incorporated businesses, which are called private limited companies and public limited companies. Following up nicely, as we just identified the difference between limited and unlimited liability, the next topic within this revision video that we're going to take a look into will be the different business forms. Now, there's a few that we need to go through. Starting off with a sole trader. Now, it's kind of in the name. Whenever you think of the term sole, you just think of one. So all a sole trader is an individual who owns and operates a business alone without any shareholders. And the reason why they operate without any shareholders is because they are unincorporated. The business owner and the business is treated as the same legal entity. So of course, they have unlimited liability. So with your sole traders, these are just typically self-employed individuals. Maybe you're a freelance photographer. Maybe you're an electrician, a painter, or a barber. And just because they are the sole owner of the business, that doesn't mean sole traders can't hire employees. Now, why would people decide to choose a sole trader as a business form? Well, think, if you are the sole owner of that business, then you have complete control over the company. Now, you can still be the sole owner of a private limited company, but you know definitely for sure as a sole trader, it will just be you. So you're the only one making all the decisions. And compared to a private limited company, it is a lot easier to start and a lot easier to run because there's not a lot of paperwork. You know, at the end of the financial year, you just have to do your individual tax returns. Now, as a sole trader, you do have the ability to turn into a private limited company. So as the business expands, you may want to make that transition. And of course, if you are the sole owner, well, all the profits only go to you. And the next type of business form will be our private limited companies. Now, couple things, breaking down the name. First of all, it is a private limited company. The key word there being private means the shares of the business are only bought and sold privately. So the private limited company, their shares are not sold on the public stock exchange. So if you wanted to buy any shares within a private limited company, you have to have a personal agreement with the current owners. And as we said, it's a private limited company, meaning it has limited liability. So the owners of the business, called shareholders, are a separate legal entity to the business itself. And as the shares are only bought and sold privately, it means that we have a lot more control of who is buying our shares of the company, which is typically why you'll find most family-owned businesses are private limited companies. Now, what's the benefit? First of all, limited liability, especially when compared to a sole trader, because that protects the entrepreneur or the business owner. And not only that, we now have the ability to start raising capital through selling shares. So I can sell part of that business away to another investor for investment. And that's going to be one of the key sources of finance, especially when we look at our Unit 5. Now remember though, we can only raise finance through selling those shares privately. We are not on the public stock exchange. But this is more so one of the benefits of a private limited company rather than being a sole trader. And finally, you could argue you have perceived credibility and reputation being a private limited company rather than just a sole trader. The next business form that we'll take a look into will be public limited companies. Very similar in nature to private limited companies, but now the key difference is that they are public, which means that our shares can now be bought and sold on the public stock exchange, which is just a large marketplace to buy and sell shares to one another. And of course, it's still a limited company, which means that the owners and the business are two separate legal entities. So of course, it has limited liability. Now, the way a public limited company is set up, typically you go from a private limited company into a public limited company. And this transition, when your shares are sold for the very first time on the stock exchange, is called the stock market flotation or an initial public offering, an IPO. Now, even though your public limited company has limited liability, I wouldn't necessarily say this is one of the main advantages that you guys should be writing for in your exams, because the option will either be a public limited company or a private limited company. You wouldn't necessarily get asked to compare the benefits of a sole trader to a public limited company. You will typically be asked to either evaluate sole traders versus private limited companies or private limited companies versus public limited companies. So these advantages are more so why it's better to be a public limited company rather than a private. Now, both public and private limited companies, they have the ability to sell their shares in order to raise capital. However, because we now as a public limited company sell our shares on the public stock exchange, that means we can raise a lot more capital than a private limited company could. And as you're getting more public investors, typically you'll have more media coverage, which tends to give you more publicity. And finally, it is probably perceived as the highest rate of credibility and reputation being a public limited company rather than an LTD. The next type of business form, and we're stepping away from those unincorporated and incorporated differences, we're now looking at our non-profit organisations. And these are entities that aim to fulfil a social objective rather than just pursuing a profit objective. And the way a non-profit organisation makes money is through different fundraising activities, such as donations, grants, crowdfunding, and anything else to do with fundraising. Now, some key examples of non-profit organisations, we've got Cancer Research UK, the British Heart Foundation, Oxfam, RSPCA, British Red Cross, and Save the Children. Now, the aim of these non-profit organisations is that they're not owned by shareholders. They don't want to make a profit to benefit those shareholders. They're taking all that money and reinvesting it back into the business activities in order to solve those social objectives. And the final type of business form that we need to go through will be our social enterprise. Now, social enterprises is within the name. They aim to serve social objectives. And these social objectives could be around contributing positively to the environment or your local communities. However, the unique thing about social objectives is that they take the best of being a non-profit organisation and the private limited company, because they want to solve these social and environmental goals, but they also have the aim of generating profit. So let's look at an example of a social enterprise of a cafe. Now, the social objectives that cafe might be trying to solve is that they want to source their raw materials more ethically. So in the process, they want to pay the coffee farmers a fair wage and fair salary. So of course, they source those coffee beans and they sell the coffee. Obviously, your customers purchase the coffee and then the business makes profit. Now, typically they will reinvest the profit back in, but they don't have to. But the idea is the reason why they want to reinvest that profit is to solve that social objective. But it's important to know, as I said, not all profits have to be reinvested. So just to summarize, it's important to know social enterprises, they solve social objectives, but they put a great importance on maintaining profitability. The next topic that we'll take a look at in this revision video will be the difference between the private sector and the public sector. Now, starting off with what actually is the private sector? Well, it's kind of in the name. The private sector consists of businesses that are owned privately. And when I say privately, they are not owned by the government. So a lot of these companies, private limited companies, public limited companies, their main aim is to make a profit to benefit the shareholders. Whereas when we look at the public sector, these are organisations that are owned and funded and operated by the government not to make a profit, but to provide those public services. An example of a public sector organisation is the NHS. Just a quick one, if you need a bit of support with how to improve your exam technique, such as how you improve your chains of analysis, how you improve your application with your answers, and also how you improve your evaluation, well, I've created a free exam technique course that goes through all of this, including the different answer structures for your 9 markers, 12 markers, 16, 20, 24, and those dreaded 25 markers. And you can access this by clicking the link in the description. Back to the video. The next topic that we're going to take a look at in this revision video is understanding what shares are and why we see either an increase or a decrease in share prices. Now, first of all, what actually are shares? Well, shares represent a unit of ownership into either a private or a public limited company. So all a shareholder is just an individual who holds a share of a company, i.e. they are the owner or part owner of that business. Now, as we said earlier, a private limited company sells their shares privately, where a public limited company sells their shares on the public stock exchange. So what you'll typically find is that your public limited companies will have a lot more shareholders than your private limited companies. And what you'll find with these public limited company shareholders is that they don't have a personal connection necessarily with the founder of the business. So the reason why someone would invest in a public limited company is to have a financial return, which leads on to a very good question. How do shareholders therefore make money? Well, they make money in one or two ways. The first way is through dividends. Now, all a dividend is after a financial year, a company may make a profit. Now, they have a decision. They could reinvest that profit back into the business, or they could give that to some of the shareholders. Now, when we pay shareholders a portion of the profit, that will be called a dividend, because remember, the profits that a company make is owned by the shareholders. And the second way a shareholder would make money is through a method called capital gains. Now, all this means is that I bought a share and then sold it on for a profit. So for example, I may have bought a share in the company Apple for $100. A few years later, Apple does a little bit better and the share price goes up to $150. Now, if I was to sell that, I've made a £50 profit, which is classed as our capital gains. But then that leads us on to another important topic. What actually causes the change in share price? Now, breaking it down to simple principles, essentially the share price would go up if you have more buyers than sellers. Essentially more people buying shares rather than selling it. But the share price would fall if you have more people selling the share than buying it. And this will actually link quite closely to our concept of supply and demand. Now, I'm going to show this very basically on a graph. On the screen here, you can see a supply and demand graph. And supply will be the level of units that a supplier is willing to produce at a given price point. So we can see it starts from the bottom left and goes up to the top right. Essentially, the higher the price point for that supplier, the more they're willing to produce because they're getting more money. Versus our demand curve. Now, with the demand curve, you can see here the law of demand. And essentially what that means is as the level of price goes up, typically demand falls, which kind of makes sense because as things get more expensive, less people can afford them. And at the point where the supply and demand line cross, we have our market equilibrium. Now, in this case, this is where our share price would be. So with this market equilibrium, you can see the share price of this company is £5 and we've got 10,000 people willing to buy it. But what happens if we was to decrease the supply? So we're going to limit the availability. Well, interestingly, this actually would begin to increase our share price because we've got less in circulation, so it might be more exclusive. Or the reason why we may have decreased our supply is that the business might be looking to buy back some of the shares. However, what happens if we looked at increasing the level of supply? Well, if we're increasing the level of supply, then we are looking at diluting the ownership that each share has. So now we want to look at shifting that supply line to the right. And once again, interestingly, when we increase the supply, this would actually reduce the share price. And then we've got the impact that the change in demand for these shares may have. Now, this is a little bit more simple to understand. Now, if the level of demand was to decrease, maybe due to an economic downturn, the business isn't performing very well, well, we're going to shift that demand curve to the left. Now, if this is the case, if the level of demand for the shares was to go down, well, it's more of a simple relationship to understand because if less people want to buy the shares, typically it's because less people value them. Therefore, the share price goes down. Versus if we saw an increase in demand, so we've seen favourable economic terms, the business is performing really well. Well, now we're going to shift that demand curve to the right. And what that would do is that would increase the level of price for the shares. And the very last thing that we need to do in this revision video is to see how different factors in the external environment can influence a business's costs and demand. And there's several factors that we need to go through. First of all, we could look at competition. Well, quite simply, the more competitors there are, naturally demand will go down because customers have more choice. And in Unit 7, we learn one of the most useful theories and models in the entire A-Level Business specification, Porter's 5 forces. And one of the 5 forces looks at the intensity of competitive rivalry, which essentially states that the more intensive competition is, potentially more competitors in the market, this will typically lead to a reduction in demand. But it may also increase a business's cost because I need to promote more. I may need to invest more into my research and development to bring a product that is highly differentiated and is innovative to get more customers. Next up as well, we could also look at market conditions. Now, these are the characteristics and dynamics of a market at a given of time. Now, just think of factors like the availability of workers. Now, when we have a larger labour pool, we may need to spend less on training because in theory, we should have access to more skilled staff. Another factor of market conditions could be around seasonality, and this can obviously have large impacts on the business's demand throughout the year. Another really important external factor as well will be around consumers' disposable income. Now, what I mean by disposable income is just the money that we have left as consumers after we've paid our important bills and we've paid our taxes. And in Unit 3, we're going to look at a real important concept called income elasticity of demand, which essentially looks at the relationship that how will a change in consumer income impact the level of demand for certain products or services. Now, if we are a normal good, a rise in consumer income will typically increase the level of demand. Or we've got our inferior goods, which are just products and services of lesser quality. Now, when we see a rise in our income, well, we've got more money to spend on nicer products. So what we may do is we may spend less on these inferior goods. But of course, if we see a reduction in our consumer income, maybe I've been made redundant, I've got to start making some cost-saving activities. So as a consumer, I may start spending more on these inferior goods. Interest rates will also be another factor. This is included within the monetary policy. Now, what an interest rate is, it's the cost of borrowing and the reward for saving. So if we see interest rates go up, the cost of borrowing increases, so the business's cost would also increase. And of course, if the level of saving is increasing, well, people may decide to save more money. And if people are saving more money, they may be spending less money. So once again, our level of demand could reduce. We can also look at different demographic factors. So these are just the characteristics of a population. So we may see a change in population size. We may see an aging population. So for example, if we saw an increase in the population, this may increase our labour pool. Think as well how migration may impact this. And as well, you may see the demand for certain type of products and services increase. For example, in an aging population, the products that are specifically suited for elderly people, well, in theory, their demand should go up because their market size is increasing. We could also look at environmental issues. So more customers are now becoming more environmentally conscious. So the demand for environmentally friendly products is increasing. But of course, to be more environmentally friendly, this may cost the business more money. And finally, we've got fair trade, which is a trading partnership that seeks greater equity in international trade. Now, the aim of fair trade is to help farmers and workers in developing countries around the world negotiate a fair trade. Now, this could increase our demand if we was to follow fair trade, but normally fair trade will increase a business's cost. So prices may also have to go up. And whether we see a big drop off in demand depends on our price elasticity of demand. But we'll cover that in a lot more detail in Unit 3. If you found this revision video useful and want to continue your revision, I highly recommend you check out our video here on Unit 2, Managers, Leaders and Decision Making. Because in that video, we're going to go through some important concepts such as different leadership styles, the Tannenbaum-Schmidt continuum. We'll also take a look at our decision trees, our stakeholder mapping, and much more. I hope this video has helped you with your revision. Thank you so much for watching, and I'll see you in the next one.